We're here to talk about home ownership. The first little background about me. I've been in the mortgage business for around 30 years, and one of my favorite things is getting people into their first home. And if there's anything we take away from today, it's going to be a life skill that you can take forward and use knowing you know how the mortgage process works. So let's get started. We're going to do a little bit of overview here, and the first couple of things is know basically how to create a budget, manage a budget, and know how much money you can spend on a mortgage. The big four part of a mortgage is the qualifications and what you need and what we see from a lender's perspective and how we judge and process mortgage loans. We're going to learn about how rates are calculated, how what affects them, and then we're going to talk about down payment assistance programs and how to do and take advantage of the assistance that's offered for first-time home buyers. In the meantime, please fill out a survey. The more we get feedback from you, the better it is for us. We love hearing from our members. We love hearing from the public, and anything we can do to assist you and help you live greater is things that we want to know. So I'll give you a few minutes to scan these QR codes, or a few moments. Very good. Well, let's move forward. Like I said, if you learn one thing, no home is worth being house poor. We all want to have that home where Elon Musk walks in and goes, "Wow, nice digs." I'm good with that. But let's be realistic about how much we can spend, especially in this market where home prices are so exaggerated. And now we have rates to deal with too. That doesn't mean that home buying's off the table. It's not. You just got to keep in mind, love the home, date the rate, and we will get you in something that helps you out, is affordable, and will be something where it's a home. You own the home. And that's the difference between renting where you can call somebody when a pipe breaks. You cannot do that when you own the home. So part of your budgeting must be for the unknown. You don't know when the washing machine's going to break, when you have to replace an air conditioner, when you have a leak in the roof, and those do not give you any warning. So, plan for things you don't know, and you will be a lot better off. We'll get into that next. Knowing how much you can afford kind of comes in different categories. And before you even start looking, I would sit down and understand that everybody's going to be different. You guys have your different habits. Maybe you go out to eat every Friday night. Maybe you have a hobby that hits you every Sunday that costs X amount of dollars and you're not willing to give that up. That's great. As long as we can account for it, we can do this. We can figure out what your housing money is going to be. The things that I look at are not the same as the things you look at when we are qualifying you for a mortgage loan. We look at your debts and your housing ratio. We That housing ratio is 45% of what your gross income is. We do not take into account you going out to eat on Friday night or that Sunday afternoon hobby. That's in your budget. We also don't know how much we don't care how much you spend for food, daycare, things like that are your business, but they must be accounted for when you are making your budget. And I hope that makes sense. I know I can get on a little bit of a tangent, so I have to stop myself and make sure that I'm getting around to the point that you guys are individuals. You have your own individual budgets and talk about them, flesh them out So you have an understanding. When I'm looking at first-time home buyers, one of the first questions I ask is, how much do you think you can afford on a mortgage? And that mortgage is broken down in between what your principal and interest payment is, what your homeowner's insurance is, what your property taxes are, and possibly what your private mortgage insurance is. And we'll get into the definitions of all those in a little bit. But in that, now want you guys to take into a factor, how much money do I spend on car costs? How much money do I spend on food, daycare, all that other things, so that you have a realistic view of what happens after you sign the paperwork. Is we do not want you struggling every month to running on a razor's edge of $100 makes the difference of whether you make your mortgage payment or not. It's not fair. And knowing those things up front can avoid that later. Charts, everybody's different. And if I say it again, I say it again. This is just I don't like this one. Having a house payment of 50% of your gross income is pretty sporty. That, not many people carry a debt load of just 9% of their gross income and still put away 10% of their savings. There's a lot of variables on here to where we need to know, what happens when the air conditioner breaks. Do we have enough money in that savings account to get that taken care of? A good loan officer will ask you those questions. Maybe I won't get into the specifics unless you ask me to, but I will ask if those things are accounted for. Do we have any questions so far?
Not at this time.
Okay, great. Let's move forward. This is the big four. Now, I like to look at this as a bar stool. If one of these legs is shaky, I can sit on this bar stool and probably have a pretty good time on a Friday night. But if I get two of these four items are shaky, now I'm sitting on a bar stool with two legs. Chances are I'm going to end up on my rear end, and that's not a good thing. So we're going to start with a FICO score. It's important to remember that a FICO score is not a reflection on who you are as a person. This is how lenders talk to each other. And what I mean by that is, let's say Mr. Smith goes out and buys a car. Mr. Smith's credit score is going to drop for a period of time. And that's how lenders tell each other, Mr. Smith just bought a car. Let's let him get used to making this payment before we give him more credit. There are several factors that go into your FICO score. Obviously, the first one is your bill pay history. Do you pay your bills on time? If that's a yes, about half of your score is determined on that factor alone. Cool. Everybody understands that. What people don't understand is, where does the other half of your score come from? Out of that second 50%, about 35% of it is based on your credit usage. And what I mean by that is, let's say you have a Lowe's card with a $2,000 limit and your balance is $1,900. Your FICO score is going to go down because you have a very high ratio of your limit versus how much you actually owe. In the meantime, if that same Lowe's card with that same 2,000 limit, let's say you have an $800 balance, that is going to add points to your FICO score because you have a very low ratio of the amount you actually owe versus the amount that you can actually borrow. The other 15% comes in inquiries like, who has looked at your credit? how long you have been in the credit reporting agencies, how many how many actual credit items do you have? Obviously, if you have 3 open accounts, is going to work in your favor versus if you have 15 open accounts. They're going to look at things like medical collections, and trust me, I know doctors who have medical collections. There are things that are just going to go into that 15% that, yes, you could control to a certain amount of time, but you can also manipulate, especially with your balances that you owe on that FICO score. The other thing about FICO, I mentioned inquiries, and here is a word for the wise. About 10 years ago, Congress got with the 3 major credit reporting agencies and got them to change their models when you take a look and start pulling credit. When I pull credit, and let's say I'm the first lender who pulls credit, you have the right to shop with mortgage companies, and you can actually, once I pull, you actually have 15 days of unlimited mortgage pulls before you take another credit hit. So the credit score I see will be this credit score that mortgage company A and mortgage company B and mortgage company C see all that. So don't be afraid to look for the right lender and look for the lender that is on your corner. If you have somebody that's just going to shove you into a program and say, this is what we do, and you don't feel comfortable with that, go to someone else. Work with someone who has your best interests at heart. So, FICO score. Debt to income ratio is the second leg of my bar stool. This is a reflection of how much debt you have versus how much your gross income is. A standard formula means that you can owe no more than 45% of your gross income to cover your mortgage payment and all of your consumer debt. This includes your car, your credit cards, and anything that shows up on the credit report. That 45% can be a gray area sometimes, but I certainly do not like to go above it, especially with first-time home buyers, because now we start running into budget issues and not having anything left over to cover those emergencies we talked about. In debt to income ratio, it does not count certain things. Like if you have a 401k deduction taken out of your paycheck, I don't consider that. I just take a look at the top number, the gross income. I also do not consider any insurance or daycare or stuff like that in your debt to income ratio. It is strictly consumer debt. Loan to value ratios, our third leg. Sorry.
Oh,
Loan to
Nathan,
value ratio. Yes, ma'am.
I'm sorry. I'm going to interrupt because these are really good questions. So I
Okay.
have a couple questions for you. Uh, if you don't use credit cards often, will that lower your FICO score?
No, actually, it won't. Having a credit card with open credit where you can use that Visa anytime you want, but with a zero balance, shows discipline. It actually reflects well in your credit score. Now, companies will want you to use that credit card. So read the disclosures in your credit card. Excuse me. If you see something like, hey, we need this number of transactions within a year, go buy a pair of blue jeans and pay that off at the end of the month, just to keep the credit active, but it does reflect good on your credit score.
Perfect. Okay, I have another one for you. What is the recommended percentage I can expect to have to put down on a home purchase? If I don't have 15% or 20%, can I realistically still buy a home?
Yes, and we are going to get to that in the next discussion with loan to value. But the short answer is I can get you done on a conforming loan with as little as 3% down payment.
Perfect. Okay. And the last one for this round. Can you get a loan if you have not worked in over 20 years? I was a housewife and divorced. Example, putting 300,000 down and need a $100,000 loan. I have a 730 FICO score and alimony coming in for payments.
Yes, at some point, we are going to take a discussion, and this is more of a private discussion, but in the interim, just because you're out of the market for 20 years does not mean you don't have experience. We can work a way to get some experience, especially if you have been on your job for a little bit more than a year. The alimony is a case by case basis as far as qualifying income. And we'll talk a little bit more about that. A lot depends on how it's court ordered and when it ends. But the short answer is yes, you can do things like that. They're more individualized, and that's just a conversation we need to have.
Thank you, Nathan.
Very good. So back to loan to value. The loan to value is the amount of money you are borrowing versus the value of the house. In shorthand, if you borrow $95,000 on a house that's worth $100,000, your loan to value is 95%. Back in the day, the rule was you have to put 20% down on a house in order to get a lender to give you a loan. The reason is if you stop making payments and we foreclose, it's going to cost 20% of the value of the house in order to pay real estate agents, attorneys, and all the other fees that are going to be involved in the foreclosure process. Lenders do not want to foreclose. That is the last thing we want to do. We want to keep people in houses. We want to work with you to keep people in houses. But we do have to plan for it. Back in the early 80s, some guy got an idea and said, wait a minute, if I take your better borrowers and I insure the difference between how much they want to borrow and that 80%, will you do a loan for them? And lenders went, well, yeah, because if we do that same $95,000 loan, and if we have a loss, if we have a foreclosure, you're going to give us $15,000 to bring our balance down to that 80 that we need. Sure, we'll do that. And that's how private mortgage insurance was born. Now, in the modern era, there are, and I'm discounting the first time homebuyer programs right now, or the loan assistance programs. Right now, you can do a first time homebuyer program through Fannie Mae for 3% down. You can do different programs through FHA where they have 3.5% down. USDA is a rural program, and in shorthand for this area, that means any home that is not in Carson City, Reno, or Sparks, or Vegas qualifies for a USDA loan if you meet other criteria as far as income, and they will loan 100% of the value of the home. Now, we'll get into a little bit about what those government programs are later, but home ownership is not blocked by the ability to do a down payment anymore. So, that's one of those things when you sit and talk with your lender, I'm going to ask you, how much money do you have to put in this transaction? Because not only will you have to account for down payment, you're going to have to account for closing costs. Then I can help you structure something and work with your real estate agent so that we make an offer that, if, let's say, for example, you have $10,000, we can make an offer on a $300,000 house where all you put in is that $10,000 that you have set aside for buying a home. The fourth leg of our stool is the reserves. This is an important category because what this is the amount of cash you still have in your pocket after you close a loan. Why is this important? It's the ability to fix the air conditioner, fix the plumbing. If something happens and somebody loses a job or gets hurt and there's a decrease in income, how many months can you pay for the home and stay in your home before stress starts to kick in? Reserves counts as the obvious, the savings accounts. What's in your checking account? The not so obvious is what's in your 401k, what's in your stock accounts, anything like that, all counts towards your reserves. That's one of those things where it's basically what's called a compensating factor, where if your debt to income ratio is in that gray area, the amount of reserves that you have can compensate for that. All right, so let's move on to the next one and hope we got our four bar stools right, and we can go on to the next thing. The one question consumers ask most is, what is your interest rate? It's a great place to start, but it is not the end of the conversation. It's very important to understand that an interest rate is a function of the market, and the market being what the 10-year treasury bond is doing on a daily basis. Just because you call me today and I say my rate is 6.875 does not mean that's going to be the rate tomorrow. It's going to change on a daily basis. There's also cost involved. Because if somebody tells you my rate is 6.5, and you went to mortgage company B and they said my rate is 7%, okay, that's great. You have 6.5. But if that 6.5 costs you $20,000 in cash to buy down the rate versus that 7%, you need to take a look at how much money you're going to save on a monthly basis to see if that $20,000 investment is worth it. This is the most talked about and misunderstood part of the home loan process. That statement could be the most true part of this. And if you take anything away from this, this is the meat of our discussion. What affects rates? Rates are affected by, like I said, the market, your credit score. The better your credit score, the better your rate. This is affected by how much money you put down. This is affected by various parts of what Fannie Mae or Freddie Mac or the government agencies are consider risky at the time you make the loan. How are rates advertised? Rates are advertised simultaneously as what the note rate is. And for shorthand, they're going to say your rate is 7%. But you'll see another figure on there that says 7.128 is your APR. What that means is they are taking the costs that are collected by the lender, adding it to the interest charge on the loan, and working and adding that in as interest to get a new APR figure. That's how much the money is really costing you. So do not pay attention to what the note rate is. Compare the APRs. And I'll give a second to let that sink in, because the APR is a formula that all lenders have to use, the same formula to figure out the APR. So those costs that add in there are costs that are directly collected by the lender. This includes origination fees, discount fees, underwriting fees, processing fees. Any fee that goes directly to the lender counts in the APR. So you can go look where someone's telling you, okay, my rate is 7%. And a creditor next door is going, okay, my rate's 6.75. But that first one, you're looking at his APR, and his APR says 7.128. And that 6.75 rate, the APR says 7.321. Then that money to get that 6.75% rate is more expensive than the 7% rate with the lower APR. I know that's confusing, but please make sure later to get my contact information. Even if you don't use me as a lender, please use me as a source so I can compare numbers for you and give you real cost on what's happening with your loan. The next subject is, what does locking in a rate mean? When you lock a rate, that means, okay, we have your loan is working. We have documents. We have a reasonable assumption that you are going to get approved, and you have found a house. Once you lock a rate, your rate is frozen. So if the market goes up the next day, your rate will not change. Conversely, if the market goes down the next day, your rate will not change. That is an area of expertise with mortgage loan officers. Good ones know how to read the market and can advise you accordingly. I always tell my borrowers, it is my job to give you options. It is your job to make decisions. And some people don't like to play that game. I'm perfectly fine with that. They will tell me, okay, just go ahead and lock. And let's lock, because we do not want to risk going upwards. Some people are a little bit more gambler, and they will ride out and see if rates will drop. Sometimes that works, sometimes it doesn't. But as long as you know what your choices are and you are making that decision, then do you. I mean, that's just a personal choice. How is my interest rate determined as a borrower? I went a little bit over that and what affects rates, but again, that's your credit score. That's how much money you're putting down. Your risk factors, like, are you a lower credit score, is a big hit. Um, the amount of money you're putting down, believe it or not, it's a better interest rate if you put down 5% versus putting down 20. Because we have mortgage insurance on that 5% down, it means the lender's safe. We know we're going to get out of it. If we put down 20% and we have no mortgage insurance behind us, it's a little riskier, just in case we get a situation where house prices are going down, like now. So, talk about that with your loan officer, run scenarios, and make sure that you're getting the best interest rate and the best payment for your budget and your outlook? What is your rate? That is the end result of all factors coming together. Um, all the factors that I listed previously, just because John Smith got a rate of 7% does not mean you can't do better. And you may well be able to get better. Stop here. And Michelle, do we have any more questions?
I do. So here's a few for you. The first one is, can a student with law debt of 86,000, good job, FICO score, but needs low payments? Not sure, the person said, not sure about the student loan repayment law will take effect. Can it stop that person from buying a home? How is student loan debt bill going to affect the loan?
Great question. We don't know much about the student loan laws or repayment stuff. We know as much as you do. But for right now, there are different programs available for people with student debt. On the average, what they will do is take a 1% of the outstanding balance if you're not making a payment now and count that as the payment. So if you have a $1,000 student loan, that payment on a monthly basis that I use to calculate your debt ratio is $10. $86,000. Okay, $860 a month is what I'm going to count in your debt ratio. If I go through Fannie Mae, Freddie Mac has a different budgeting process and can actually cut that monthly liability for qualification purposes in half. So a lot depends on who's got the better rate between Fannie Mae and Freddie Mac. Can you afford the loan on the fully if I'm using $860 versus $430, and what program is actually best for you? In shorthand, yes, we can work around that. We just have to know the other factors like what's your income, where do you want to, you know, what's your expectations for down payment and that sort of thing so that we can get you in the correct program. There are programs out there that will completely discount student loans, but the rate that goes along with those programs is not really appetizing. So I kind of shy away from them.
Thank you.
Next.
Okay. Next one. Can you speak a little bit about buying down rates? How does the process work? Can anyone buy down their interest rate?
That is a great question. And yes, we can buy down interest rates. What that means is that you or an interested party is going to give the lender money to decrease the rate. And when I do this process, and I don't have a rate sheet up, so I can't, but I'll give you a good example. Let's say it costs $2,000 to drop your rate an eighth of a point. I'm going to take the difference in payments between what your natural rate is and what that decreased rate is. And let's say it costs that $2,000 and you drop $15 a month. Okay, we're going to divide. Michelle, do you have a calculator?
I can pull one up for you.
Well, 2,000 divided by 15. If you're saving $15 a month and you spent $2,000 to do it, it's going to take 133 months to get your money back. So we're going to take a look and say, okay, are you going to be in that property 133 months? Now, sometimes it's more than 2,000, sometimes it's less than 2,000, sometimes it's a $200 fee to drop that 0.25%. It just depends on what rates are. The best way to use that tool is get the seller to do it. The seller in most transactions, conventional and government, can put anywhere from 3 to 6% into the transaction on the buyer's behalf. So there's nothing wrong with telling that seller, sure, I will buy your house, but you're giving me $2,000 to buy down my rate. Then we can work that as it seems appropriate and make sure we have the discussion about, is the amount of money you're paying to buy down the rate advantageous to you, or are you better keeping that money in your pocket and keeping it as reserves, knowing that you won't be in the house, let's say 133 months. And I hope I answered that question, because that's
That
again, that's a market dependent answer.
yeah, no,
And
that's awesome.
we definitely want to go over that and review that while we're in the mortgage process.
Okay, I have one more
Next,
question for you. What is the recommended minimum time of employment?
good one. I like to see 2 years, but we can work with as little as 1 year, depending on what you were doing before. And let's go talk about your person that was unemployed for 20 years as a homemaker, or whatever you want to call it nowadays that's politically correct. Sorry, I'm old. Um, there are a lot of things that experience wise come from being a parent that stays home. You have budgeting experience. You have all sorts of problem solving skills that are valuable in the workplace. If you go into a job that uses those skills, then obviously we can do that and make it so that we can, determine, yeah, this person has experience doing this job. Now she's been there a year, or he's been there a year at his job a year, and we're good to go on that. It can even be shorter than that if you get a job when you're coming out of school and you get a job in the arena you studied. So if you studied accounting and you get a job as an accountant, I can do your job and get you approved in as little as 2 weeks from the day you start. Just get your first check, because you have experience in accounting when you went to school. That 2 years experience is the key, not the time you've been with your present employer.
Thank you, Nathan.
All right, so let's move on here. Products and process. There are definitely three arenas: conventional, government, and jumbo. Conventional is the very vanilla Fannie Mae, Freddie Mac loans that 90% of the people buying a home use. These have the best rates and the best advantages towards the borrower. Government loans are VA, FHA, USDA. They are very good niche loans. They are designed for a lower down payment for the most part. They are designed for a more flexible borrower. Maybe you have a lower credit score and the pricing is better on a government loan. The government loans have very good benefits for rural processes, especially VA. VA for veterans means you have no down payment and no mortgage insurance. That's a great thing, and I use those anytime I get a veteran. USDA and VA, USDA and FHA are considerations when we are going through the qualification process. We're going to compare what the cost monthly on a conventional is and the cost monthly on a government is. And then there's a couple things on a government loan that we need to understand. Maybe the monthly payment will be lower, but the government loans have what's called a funding fee. These funding fees are added up on top of your balance. So if you borrow $80,000 and you have FHA has a 1.75% funding fee, they're going to take that funding fee that's about $1,500, add it to your balance, and on your first statement, you're going to owe $81,500. Okay, that's great. They also do not have mortgage insurance. They have an annual funding fee that, depending on the program, can be, you know, $350 per 100,000 that's added to your monthly payment every month. So you take that 350, divide it by 12, that much is added to your payment every month as a annual funding fee that never goes away. So I like to use these when the payment is cheaper, and this house, especially for first-time home buyers, is a starting point or a jump off point where you know you're going to be in this house 4 or 5 years, but you're going to move to something bigger and better down the road. Those are individual conversations we have during the qualification process, but there is a difference between conventional government. Jumbo loans are loans that we use when you borrow above the amount that Fannie Mae currently has set aside as a limit. Right now, that amount is $732,000 and a little bit of change. So if you wanted to borrow $800,000 against $1 million house, all right, great, we can do it. We're just going to be on a jumbo loan, which is going to be a little bit more expensive rate, but some benefits on the other side. It's just not a conventional conforming loans. There are programs that can attach to these products. For instance, I already mentioned Fannie Mae's first-time homebuyer program attaches to their traditional product, and it brings down your down payment from 5% to 3%. There's also tricks of the trade. If you really want to know how to crowdsource a down payment, call me later. Down payment assistance programs. I'm gonna save this one for the next slide, but we're gonna walk you through which options you have. That's part of that process where we first sit down. I determine what's your budget, how much money you have, and what options we have to get you to where you want to be. This is not just to put you in a house and say, congratulations, here's the keys. Yeah, that's a major goal, but it's not the only one. What I want to say is, congratulations, here's your key on a house that you have a payment that you can afford for the next 5 or 10 years, and you don't have to worry about where your kids are going to grow up. This is your home. Now let's talk about down payment assistance. There are groups, Home is Possible, Home Ready, that will give you anywhere from 1 to 5% of the down payment you will need to get in a house. It's a great thing. What they do is they will lend you the money on a bond program, and then they will put what's called a silent second mortgage on your property. And just for simple math, let's say you want to buy a $100,000 house and you get a 5% grant. That 5% grant is $5,000. When you sign the paperwork, that $5,000 goes as a mortgage, and it's silent because there's no interest and no payment. That mortgage gets forgiven, and depending on what program, is in between 3 and 5 years. 3 to 5 years later, they will take that program or that mortgage and they will release it, and it'll just go away, and you will never have to pay a penny on that grant. However, if you decide the market has changed in 2 years and you want to refinance and get a lower rate, you will have to pay off a prorated portion of that grant because you didn't keep it for the agreed upon 3 to 5 years. Okay, we will talk about the advantages and disadvantages of that as we go through and sit and talk about, okay, do you want to use a grant program? The converse part about the grant program is we have to remember nothing is free. So in exchange for getting a grant, you will pay a little higher rate on both a conventional and a government loan through Home is Possible or Home Ready or any of the other grant programs that are out there. They do have eligibility requirements as far as credit scores. The minimum credit score right now is 640. And some of those programs mean you have to be within a certain range of what the average median income for the county you want to buy in. Typically, that's 80 to 110% of the average median income can qualify for what down payment assistance can offer. There's also some programs that don't care how much money you make. As long as you're willing to pay the rate, they'll give you some down payment assistance. I'm going to stop here. Oh, I hit the wrong thing. Do we have any questions about down payment assistance?
I don't see any at this time.
Okay.
Oh, wait,
cool.
I do have one question.
Yeah.
It says, I purchased my first home years ago, but sold it. I would love to get back in the buying market. Can I become a first-time home buyer again?
Absolutely. The definition of a first-time home buyer is someone who's not owned any property for 3 years. So yeah, if you and I found myself in that situation where I sold my home. I lived in an apartment for 4 or 5 years, and now I'm a first-time home buyer again. Now, I own a home, but you can see how that can work to your advantage. Just because it's not your first rodeo doesn't mean you can't get in on some of these programs.
Thank you.
All right. So list of the programs around in Nevada right now. Home at Last. The teachers program is very cool. That teachers program will give you $7,500 towards your purchase if you are in a educational job that will, benefit. Home is Possible, Home First, Within Reach. One that's not listed on here right now, and in case some of you guys are looking, Greater Nevada is hooked up with a credit union in California. This credit union in California administers what's called the WISH program. The WISH program is a program for people that make less than 80% of the average median income of any of the county you want to buy in. What they will do is match your down payment. So if you have $5,000 down and you make less than that 80% level, we will give you an additional $5,000 down to help with your down payment and closing costs that has no strings. It's just done. The problem that happened with that is the people that are under 80% have, with the increase in rates, have not been able to buy homes recently. So that money that they have set aside for that program, they need to get rid of. What they did last week was give Greater Nevada and 29 other lenders access to $10 million. This $10 million can be given in $50,000 grants. If you make between 80 and 120% of the AMI can qualify for a conventional loan, have 10% on your, or $10,000 on your own, which can be a gift, and you're a first-time home buyer, which means you haven't owned any property for 3 years. If you can meet those 4 qualifications, you can get a $50,000 forgivable grant at closing. Hurry, hurry, because there's $10 million, $50,000 a piece. Do the math. That's 250 loans between 30 lenders. That money's not going to be there long. So if you have any questions about that, definitely reach out to me ASAP so we can get you working.
I do have one more question. Sorry,
Sure.
Nathan. Does the teacher program down payment assistance still potentially raise interest rates?
Yes. Yes, it does. So what we will do is we will take a look at what the teacher program is offering, and is the raise in the interest rate worth the $7,500 grant? Sometimes that a lot of times it works out that yes, it's worth it. Because if you go up an eighth of a point and your mortgage payment goes up $30, and you're gonna refinance as soon as we are out of this rut, and that's an individual opinion, but for the most part, when you go into a rougher economy, rates go up. As you get out of that, rates go down. If you think we're going to be out of this economy within the next 2 or 3 years, it's worth doing a little higher rate now, as long as you can afford the payment, because you will make money on that $7,500 grant. And that's an individual discussion. But for the most part, the answer is yes, but don't let it shy away from it.
Thank you, Nathan.
Any other questions?
It doesn't look like I have any.
Very good. Again, here's the surveys. Please help us out. We'd like to see any feedback that you have. Please don't put Nathan's glaring bald head. Made it hard to see the screen. We already know. The EverFi courses are wonderful. We want to make sure, again, that you own a home in the way that's beneficial for you. Make sure this has a very extensive list of the other costs of owning a home, and making sure you account for that in that initial budgeting process. And I will leave this on here. And please, any other questions, either reach out in the chat or get my information on the next couple screens and reach out to me individually. We're Greater Nevada. We're interested in our members, not making you a mortgage loan. We, of course, want to be your lender, but having you fully armed with information is the most important step. Here's my information. I can be reached pretty easily on either my direct line or my cell. A lot of times my cell's the best place. I return phone calls. If you call me in the morning and I don't answer, I'll call you by the afternoon. If you call me in the afternoon and I don't answer, I'll call you by the next morning. But I love having these discussions. I love talking about the individual things, and getting people into homes is the number one priority. I have never, ever known a millionaire or done a loan for a millionaire that doesn't own property. Michelle, we got anything next?
All right, Nathan, I'm going to plug in. Hi, Nathan, and hello,
Hi.
everyone. My name is Saray. I'm the Community Relations Specialist here at Greater Nevada. I don't see any more questions at this moment, but just like Nathan said, if you do, we are 100% here for you for your questions. So Nathan's information is over in the chat, but not to worry. We'll be sending out some more information. So with that, I'll just say thank you so much, Nathan. I even learned today. So I appreciate your time. And thank you so much, everybody, for attending this Greater Financial Wellness webinar. And we hope we see you in the future. But again, if you have or need follow-up information, you can reach out to myself, but also expect an email from us with more information. And if you're interested in learning more about these webinars or any of the financial wellness and literacy programs that we talked about today, you can go ahead and hop on over. They're just on our website at gncu.org, and you can search for the Greater Financial Wellness Hub. If you want to revisit this webinar, it is recorded and it'll be posted on there at a later date. So not to worry. Again, I think I'm going to revisit this one or have a couple of my friends or family. My little brother just turned 18, and this is going to be a great one for him. So again, thank you, Nathan. And thank you, everybody. We'll leave it to the rest of the day.
Thank you, everybody, for taking your time. It's really appreciated. Have a great day.
Thank you.